Hi, everyone. My name is Tyler Rush. I'll be your moderator today. And today we're going to be talking about Bitcoin's security budget and Bitcoin's BlockSpace as a commodity. Security budget is something that comes up, consistently, pretty much around every halving, and the importance of it. And I'm quite excited to be joined by three panelists today. The first one being Nick Hansen, CEO of Luxor Technologies. Second being Peter Todd. And third being Ben Gagnon, Chief Mining Officer of Bitfarms. All right, so I'll start off with Peter. Peter, now can you briefly explain the concept of Bitcoin security budget and the importance of it in your eyes?
Well, so there's really like two basic parts to this, and I think the part that probably comes to mind most for people is obviously 51% tax are a threat, and total mining reward has to be big enough to keep 51% tax away. Obviously, if total mining reward was like $1 a day, some asshole would just go in 51% tax Bitcoin for the fun of it. There is a limit to how low this can be. Although we don't really, it's hard for us to know how low that is because you only find out when it starts getting attacked. The second, I think, much more subtle thing about the concept of security budget is you want miners to have incentives to continue making blocks. And there's some subtlety to this around reorg attacks and fee sniping and so on, but I think the key thing to keep in mind is just, unless there's always that incentive to keep building new blocks, a lot of protocols built on top of Bitcoin don't work properly, and also the user experience of Bitcoin is bad. If I can't rely on a confirmation being a confirmation, that causes a lot of problems with the way we use Bitcoin right now.
Thank you. Now, Ben, do you have any thoughts or disagreements on that subject there?
Yeah, I think the idea around a security budget obviously has been going around for a long time, but the problem here is based on a flawed premise. And it's based on the premise that we are going to consume electricity at the same rates that we've been paying electricity for the last 10 or so years. The reality is not that case. Bitcoin mining is moving to marginal cost sources of energy. And there are energy all over the world which is being underutilized and wasted. And when I don't have to compete with somebody else for that unit of energy, I get a much, much lower price. And there's energy all over the world that has a zero price or a negative price because you need to have electricity supply exceeding electricity demand. It's the only supply-demand curve in the world where the optimal solution is not where they intersect. You have to have more supply than demand. That creates an imbalance, and it creates a pricing system where you can get paid to consume your electricity. And this is what we're seeing in the industry now, a move to marginal cost sources of energy because we do not control our revenue as miners. We can only control our cost. And so you need to get hyper competitive on cost controls. In order to do that, marginal cost sources of energy, eventually everybody's going to be having a very different view of their Bitcoin mine. We are not going to be having 100% uptime and paying something like an industrial rate. You're going to have a highly flexible load which is on fractions of the time and is being paid to consume electricity when that electricity needs to be consumed. In that way, the security budget is actually funded by the state. And the state is funding that by creating an inefficiency in the electricity system and the energy markets through bad policy.
Thing is, I'm not sure we actually disagree here. I know going into this before you're talking about assuming we disagree, but when I think of security budget, I'm not necessarily thinking of a dollar cost directly. I'm thinking of, what's the thing that gets hash power to do its hashing? And it's a good thing when hash power gets widely distributed across very niche energy sources or energy, reasons to consume energy, because those sources tend to be very widely distributed across the whole world. Now, you want the sum total of that hash power to be sufficiently high that someone doing an attack is unable to get enough or buy enough hash power to do the attack. And that's kind of, I think, what you would call a security budget. But that doesn't mean the idea is obsolete. It just means the nuances of exactly what the numbers mean are different. And after all, we always got to remember, difficulty adjusts. Fundamentally, whatever costs go into this does kind of even out. And if, for instance, you're being paid to consume electricity in niche cases, you're still going to have costs associated with it, like buying the hardware, having the guy on the phone every once in a while talking to the utilities. I mean, there's a whole bunch of stuff like that. It's not like this is magic. There will still be a revenue and a cost associated with it.
Just jump on that really quickly. I think the importance of this with the move to marginal cost energy is that when you have an energy price which is zero or negative, it really does not matter the energy efficiency of the machine that you're mining, because the marginal output from consuming and monetizing that unit of energy, even with a low efficiency machine, even with an S1, is better than zero. And so the optimal solution for everybody is going to be monetizing the most amounts of energy with the least amount of capital. That means recycling old units into productive use cases. And so, to think that like, hey, we're going to have 20% uptime and we're going to pay for the newest miner, no, that's obsolete, that model. What'll happen is companies who want to monetize the most units of energy for the lowest capital expense will buy the older machines and they'll run on marginal cost electricity. And then you're going to end up with a highly variable load.
So we actually didn't talk about what the security budget really is. That's the 6.25 BTC that comes out of every block. That's about $25 million a day. But why does that even exist? It's so that when somebody is mining, you're basically incentivized to go earn that $25 million. And if you don't, if you act, I guess, against the rules, that's what's at stake. So you need to be able to capitalize on getting and be able to get more than $25 million a day by doing some sort of attack against Bitcoin. That's what the security budget is for, and that's why it exists. And that $25 million is coming out of everybody that holds Bitcoins. You're basically all being diluted by every block, 6.25 plus, I guess, no extra transaction fees. But and that's where that security budget comes from, is through dilution or inflation of the supply. And so that's why we're talking about, is 25 million enough? Is it too much? It seems like a lot, but we are also securing an asset that's worth $500-ish billion. So,
yeah, that's perfect. Ben or Peter, do you have anything to add there?
I think when we look at the incentive structure that Satoshi originally created, you can argue about whether or not it could have been improved or optimized, for sure. But the actual spirit of the incentive is actually really beautiful, because what he's done is he's really well managed risk versus reward. If you were back there in 2009 or 2010 and you were saying, do I want to go through all the effort of learning about how to set up a Bitcoin miner, actually running and maintaining a Bitcoin miner in my house, like the incentive to do so is very low, because there's no value to the Bitcoin at that time unless you're thinking about the value in the future. And so in order to incentivize that behavior that had to bootstrap the network, they gave you a very, very large reward. So if you were going to take on that speculative risk that Bitcoin could do what we hoped it could do, you were going to get an outsized reward. And over time, as Bitcoin proves itself as a stable asset class, as the preferred monetary asset of choice, that reward goes down because the risk has also gone down, right? The more and more Bitcoin is around and the more Bitcoin gets adopted by institutions, by countries, by people around the world, then that means the risk of it being a monetary asset or achieving its escape velocity becomes lower and lower, and the risk matches that reward. And so it's a beautiful system.
But from an early onset, that US dollar, from a US dollar amount, like a fiat dollar amount, it's actually quite low. 50 Bitcoin early on was a couple $100. Yeah, zero, a couple $100. And then when you went to 25, and now a block of Bitcoin is like $180-ish thousand, maybe a little less. So right now you're actually being it really tracks the market the market cap of the network, is how much of the security, or how much security budget we end up requiring, or at least it seems like the market. It seems like the market tracks the market cap for that security budget.
I mean, you got to remember, the way the math ends up working on this is, provided you go have, at least in the short term, a fixed amount of Bitcoin per block that's getting created out of thin air, the inflation tax, any implementation is going to have this property where inflation is really high in the beginning, and you're getting rewarded a large percentage of it, and then it drops down. I mean, that's just the way the economics of this kind of system works. And I don't really think like Satoshi picked anything special. He just happens to go pick some silly halving thing when basically anything you pick has this property. Even if it was like 1 Bitcoin per block forever, it would have this property. It's actually kind of hard to avoid having this property because you got to do weird stuff like Zcash did in the initial launch, where like you start with less coins and then you get more.
All right. Does anyone have anything to add on Peter's point there? All right. So the second half of this is, the concept of Bitcoin's block space as a commodity, which I think closely ties to, the value of Bitcoin's security budget. And I want Nick, can you explain, what is BlockSpace as a commodity? Can you break that down?
Yeah, so BlockSpace is that's the what's it, 2 to 4 megabytes, depending on what kind of data you're putting into each block. That includes all the transactions, pictures of JPEGs and monkeys and things like that. All that stuff that you can put into the blockchain, that's called BlockSpace. Bitcoin miners, they produce hash rate, which is then turned into block space, and the network effectively is buying that block space from you for the subsidy. So every 10-ish minutes, it's paying you 6.25 BTC for the block space that you've created. That block space is basically is already been validated and secured by the network, and then it's added. Super high level. That's underpins basically the way that Bitcoin works. Now, as a commodity, we're seeing that like more and more miners are coming online. Mining is looking a lot like a commoditized business, very similar to corn or oil, where corn and oil production are fully commoditized, and there's hedging strategies for those types of businesses. We're starting to see those types of markets form for hash rate and Bitcoin block space. Hash rate and block space are sort of kind of the same. Like hash rate produces block space, but you can kind of think of them as the same thing.
Although I got to point out a very important difference between sort of a conventional, like corn as an example. If you want the supply of corn to go up, you can invest more money, and in the long run, you really can get more corn every year. You cannot do that with block space. The supply of block space is fixed. The security of that block space, you can increase that by throwing more money at miners, but you will not get more than up to 4 megabytes per block. That's just how it is, and that's I think where some people kind of trip over, and they start thinking the commodity analogy applies stronger than it really does. It's not like paying miners more is going to increase that. It just means your particular transaction outbids other people. And I got to point out, some people don't realize this, but mempools, minor mempools, they act as an auction system. You are auctioning off block space for the next block, and you go pay your bid, and if it's high enough, you get in.
I don't think the market has fully realized what block space is yet. When we say we're the most secure blockchain in the world, like there's a meaning behind that. We live in a world where everything is now murky and unclear. And people lie, people obfuscate, people distort, people distract. There is only one inherent truth at the end of the day. But many people can have their own individual truths or realities. I think that really distorts the economic incentive. I think that really distorts human society. And when people need to get back to that kernel of truth, you're going to need to have something that's incredibly secure and resistant. And that's what the block space is. People haven't really found the value or the applications for it, I think, yet. We've seen lots of different emerging applications for it. I think in 10 years' time, are we going to be talking about ordinals? The probability is incredibly low, right? Are we talking about, in 50 years, ordinals? I think even less. Right? But the probability that block space is going to be valuable by institutions, by governments, by companies, by people who want to ensure their rights and want to ensure their information, want to protect their assets, they're going to have to link them to the blockchain and the most secure blockchain that exists.
So how can you ensure...
I got to point out, I'm very bearish on this because tech guys like me keep on finding ways to do more with less block space. Like my own open timestamps project, with one single Bitcoin transaction, I timestamped basically the entire Internet Archive, which is like God knows how many petabytes worth of data. With clever math, you can push this really, really far, and there's only certain applications that actually need to be on a chain directly.
Those types of transactions are things like, so I don't know if anybody has heard of BitVM or drive chains, any of those types of things. Those are places where you need to consistently consume block space. Basically, you're checking in the state of some side. Very, very basically, you're checking in the state of some side chain consistently to the blockchain. We already see this in ETH, so Optimism, all these roll-ups, they do that where they basically consistently are checking in the state of the side chain into the main chain. And that way, there is consistent demand for block space that is somewhat, I guess, resistant to really the economic factors. So generally, we see high demand for block space during bull markets. 2017 comes to mind. Even late 21, there was a surge in transaction fee, mostly because people were moving their Bitcoin around to trade shitcoins on shitcoin casinos. But now we see, with some of these other types of like side chains, drive chains, things like that, they're actually pushing some of that state into the Bitcoin network, and that is consistent demand, organic, consistent demand.
So I guess the question I would have, kind of throwing it back to you, is right now, fees are pretty consistently, besides the ordinal craze and around the halving when a lot of coins are moving around, transaction fees are 2 to 3% of mining revenue. How can we create that resilient fee market? I know we talked about the concept of block space as a commodity,
right,
and eventually it's hopefully gonna keep growing. But how do we create that? Is it ordinals? Is it drive chains? Is it something else? And then I want to hear Peter's thoughts about how he can kind of
certainly.
that.
So I mean, pre-ordinals around would have been maybe this time last year was actually kind of the transaction fee winter. It was like less than 1% of total block reward came from transaction fee. Then over the course of the Q1, late Q1, early Q2, when ordinals really kicked off, we started seeing like higher transaction fee amounts, but not much higher. We went from like 1 sat per VByte to like 5. And people were like, wait, but my JPEGs, they're huge, they take forever, or take so much block space, but they were very low time preference, meaning I didn't really care if my JPEG went in now or if it went in 24 hours or in a week. As long as it gets in, I'm good with that. So I'll put it at 5. But then there was this concept of something called the BRC20, which is basically, it's this really janky protocol, but basically it has some time preference, meaning I needed my transaction to get in before yours. And if it do, I'm going to make like $50,000. So I don't care how much the transaction fee costs, so I can have this really high time preference type of transaction. That's when we saw transaction fees absolutely skyrocket to more than 100% per block. There was a whole day where the like 80% of the reward was transaction fee for miners. May was a great month, was it not, Ben?
It was good.
May was a great month. So anyway, we see this sort of organic demand for block space, but it needs to be high time preference. And that's why I think something like drive chains, I don't know if drive chains are ever going to succeed. I'm not even up to speed on how they work too well. BitVM, all of these ideas where there is this high time preference, you have to check in the state of these side chains into the main chain could be kind of the catalyst for sustained high enough transaction fee to make up for the halvings.
Yeah.
I got to point out, maybe you won't be too excited about this, but I don't think BitVM works the way you think it does. It's more like a lightning channel where the only time you go on chain is if someone screws up. So really, and again, going back to what I said earlier, BitVM I think is an example of very clever mathematicians figuring out ways to avoid actually ever using blockchain space. And while I agree you do get some use cases where you get sudden demand, they are few and far between. And I know you mentioned drive chains. Well, with drive chains you do have this fundamental problem, which it doesn't have a block size limit. The supply of blockchain space is unlimited on drive chains, so there's no reason that's going to kick up demand other than artificial scenarios. And I got to go say, I think the ordinal stuff in BRC20 or so on, that's an example of an artificial situation, which you can't really say you're going to depend on, 5-10 years into the future. Now, maybe as Bitcoin gets bigger and the way people use it gets bigger, maybe there will be enough overlapping things that you do get consistent transaction demand. I can't predict the future with 100% accuracy, but I also can't go say that this will happen that way either.
I don't think that the ability for mathematicians and programmers to be able to move more and more data into a block is a problem with creating a market. The world has infinite data needs, infinite storage needs. data centers grow at an incredibly rapid pace throughout society, and everything that in our life is dependent on those data centers, is dependent on that data, and it just grows in ever exponentially increasing volumes. And so for the ability, Bitcoin creates a platform, and now it's up to the individual users to figure out what's the best use cases in order to use this platform. And the free market's going to decide all these different things. But if we're into a situation where that block space is important, especially if it's important for confirming historical accuracy of documents, where banks have to maybe to do a daily hash function, or companies have to do a daily hash function, that is going to somehow link that those records were not altered, they were not destroyed, they were not manipulated or whatever in the future, and there's a massive amount of demand for that space, then the free market is going to create a system where even if they can't do it directly or can't afford to do it directly, they're going to do it through an intermediary who's going to hash, thousands of these transactions together into a space. And so there's an ability for, us to use cryptography to basically make these block sizes completely irrelevant. I think we won the block size wars. We're never going to go back to block size wars and fight for bigger blocks. I don't think that's ever going to happen, right? And so now it's up to the ingenuity and the creativity of people to create different solutions, embrace technology, and figure out how they can make this work for them in an economical way. And I think there's infinite ability to do that.
Yeah.
I mean, to be clear, you mentioned historical data. My open timestamp project is aimed at exactly that. And I absolutely can go timestamp the entire world's data in one Bitcoin transaction. I mean, these kind of use cases I do not think actually drive transaction demand. It's good from the point of view of users, but from the point of view of how do we ensure that there's money to go pay miners, I don't think you can bet that these things will do it.
Do you think there could be a case where there's enough overlapping mechanisms like this, like the BitVMs, like the ordinals, where it could proliferate a consistent and valuable fee market for miners?
It could. It also may not. And there's no guarantees either way.
Yeah.
I still don't think you need the transaction fees in order to fund mining, because I truly believe that everybody is moving to marginal cost energy sources as miners. And when we move to zero cost energy or negative priced energy, that is the economic incentive already, right? We do not need a massive transaction fee market that's going to somehow save us, from our own existential crisis. We're a free market. The market will respond accordingly and will mine when it's profitable to do so. And if you don't mine when it's profitable to do so and you're mining unprofitably, it's not sustainable, right? You have to fund that via some other pathway. And eventually you die out, and only the profitable people will remain. We do not need 400 exahash to maintain a secure network. That number is arbitrary and changing with the technology and the times. It really does fluctuate and changes. And if the margin is so low, that means the cost to attack the network is even higher, right? Because now if I'm a nation state and there's zero reward, now I'm funding it all completely out of my own pocket. Now I've got to pay 6 cent energy for no reward other than attacking the chain. It becomes exponentially more expensive when people move to marginally cost electricity.
Yeah, Nick, what are your thoughts on that? That's an interesting take.
Just so we know, that she's the CMO of Bitfarms, and that's Bitfarms' strategy. That's what they're doing. So you have to say that. But I don't think that I don't think that there's going to be enough. Right now, I'm concerned about the transaction fee of volume being a problem for miners. Maybe not this halving, and maybe not the next one, but the one after that, certainly, when we get to a point where we're only, if we're still only having half a Bitcoin worth of transaction fee volume when we're getting close to 1 Bitcoin, that's going to be a really big problem. I think, Peter, you had a lot to say about this as well.
Yeah, I mean, you got to go fund enough security that some asshole, without necessarily a direct monetary incentive, can't say one day, hey, we're going to go kill Bitcoin, let's go buy some hashing power, pay some money for electricity. And unfortunately, the size of those potential assholes, which, might be a pissed off government as an example, it's unknowable till it happens. And once it happens, it could easily kill Bitcoin on one go. So we want there to be some amount that's affordable. And, I've always made the argument, if we had a system where, say, 0.1% of all Bitcoin value wound up going to miners, that's definitely affordable. I mean, 0.1% compounded over like 50 years is what, 10, 15%? Someone can do the math on it. But it's not very much money. Like, that's like saying, well, to keep your life savings secure over like your entire 50-year savings period costs you 10%. I mean, I'm sure gold's vaults costs tend to be more than that. And then the second issue is sort of more in the weeds nuance thing of we do need a reward to exist for Bitcoin miners every single block, or you get weirdness where it starts becoming profitable to reorganize blocks. And unfortunately, I just cannot agree with this idea that somehow marginal price energy will go fix this. Because in cases, for instance, like using up excess energy, which is a very real case, I mean, negative electricity prices do exist, but I can much more easily meet that demand with a resistor bank than I can with a bunch of expensive silicon doing clever math. And I know for a fact electricity grids actually do use resistor banks in some cases that just dump the electricity straight to heat. Like mining's got to compete with this stuff.
Yeah, Nick, I'll let you go next.
Okay, yeah, and then if everybody were on marginal energy, then there would be no security for Bitcoin anymore because the cost to attack the network is then zero. Really, the only cost then at that point is your opportunity cost of the security budget, which is what, 25? Like I said, about 25 million. So that becomes even easier to attack the network if everybody's on marginal costs. So, and I don't think we'll go to marginal costs just because energy inherently has value, and I don't think that it just happens to be there are times energy is sparse. I don't know if that meaning it's generally distributed equally around the world because the sun hits over millions of years the Earth in pretty much the same amount all over. It just so happens to be that some places have it, there are pockets where it's more densely accumulated over time, like in the bones of dinosaurs. Or, sorry, that's a joke. That's an inside joke from a long time. But anyway, biomass in the form of oil, hydro, that sort of thing.
All right, actually, I'll let Ben pass it because we are debating Ben's point a little bit.
The marginal cost energy thing here is really, really important because when we're looking at Bitcoin, and I think any investment in Bitcoin or anybody's interest in Bitcoin primarily relies from a distrust of fiat and a distrust of government. Like if that wasn't your original thesis coming into the Bitcoin, I really don't know why you're here, to be honest. I mean, that's basically why everybody's here. And when you look around at the world, governments are really, really good at screwing things up. It's like their number one core competency is just screwing things up. And, electricity hasn't been around that long. I mean, you go back 100 years ago, most people did not have electricity. There are people today who do not have electricity. We have reliable forms, we have unreliable forms, and in order to unlock human prosperity, we have, since the beginning of time, sought out sources of energy with higher energy density, higher efficiencies, and lower costs. We've gone from wood and fire to whale oil to coal to crude oil to nuclear. And every single time we've unlocked more and more powerful forms of energy, more efficient forms of energy. The government solution right now is to embrace 1,000-year-old wind technology and shove it all over the earth. I just drove through Germany last week. I have never seen so many windmills in my entire life. It was the entire country from end to end in every single direction. It was windmills, windmills, windmills. And the only thing they've done there is create a marketplace for energy, which has driven up the cost dramatically. And when you do that, you are going to drive out your entire industrial base. And the only people who are going to be there is miners. They're going to create volatile energy systems and volatile energy pricing. This is the reality of the world that we're in. Governments will screw up electricity, and Bitcoin miners will be there to absorb that inefficiency through Bitcoin mining and make a profit. And it's the profit incentive that drives us all. If we are doing this just to secure blocks, I'm sorry, it won't survive.
I mean, to be clear, when we go talk about this low-cost, even negative electricity, the reasons why this happens at an electrical engineering point of view really comes down to how generators work. If you have a coal-fired plant, it's this very hot thing. It's a literal fire, and you use that literal fire to generate steam, and you run that steam through a turbine. And the way that system works is that unless you want to risk damage to the system, the much saner thing to do is keep running the steam through the turbine. Well, the steam through the turbine means you generate electricity. The electricity has to go somewhere, and it just happens to be that it's cheaper in many cases to pay someone else to absorb it rather than literally open the valves and send steam up into the atmosphere. But like this is a relatively niche thing. In a lot of cases, as electricity prices get lower, wind turbines being an example, it makes a lot more sense to just go turn the blades a little bit this way, and then they just spin harmlessly in the wind, and you reduce wear and tear. I mean, that's not an opportunity to actually get free electricity or paid electricity. It doesn't actually make sense to produce at that low amount. And I think there's this dream in Bitcoin where, it'll all be this low or free or paid for electricity, and I don't think this actually works from an engineering point of view. But, what can I say? I used to do analog electronics, and I look at this, and it's like, it doesn't make that much sense.
All right. Well, I wish we could actually dive into that further, but unfortunately we're at time. But, appreciate everyone's time. This was a great conversation. Let these guys know on the side if you have any questions.
Thank you.
Thank you.
Sir?
Thank you, Miami, for the last 3 years in this amazing city. The whole world shut down, but Miami welcomed us with open arms. We want to show Bitcoin to the whole world. We are taking the conference on the road to set the stage for Bitcoin in a new city. Nashville. Bitcoin 2024 is coming to Nashville in Tennessee, a city that is known as a music and freedom city. Bitcoin 2024 in Nashville from July 25th to 27th.